This is a textbook perfect setup. You identify an upward trend, enter long, and place your stop loss below the low. Suddenly, price drops to precisely hit your stop loss. The moment you're out, it aggressively reverses in your predicted direction, leaving you behind. It is easy to feel targeted in this moment. You might wonder if your broker is watching your specific account or if the entire system is rigged against your individual trades. These sharp reversals are a mechanical necessity for the largest players in the market. Financial institutions execute these maneuvers to solve a very specific problem caused by their own size. Individual retail losses provide the necessary order volume for these massive institutional positions to be filled. To see how that works, we have to look at the market from the perspective of a global bank. Consider the scale of a major institution. If a bank needs to acquire €500 million, they cannot simply click a button and expect a smooth entry. An order of that magnitude would instantly overwhelm the current market. Their own massive demand would drive the price up before the order could even finish filling. This chart shows why size is a disadvantage. While a retail order fills at a single price, the institutional order causes the price to skyrocket during execution. This is slippage, and that results in an average entry price that can ruin the institution's profit margins. To enter a position of this size without moving the market, they need to find a concentrated area where thousands of traders are already trying to sell. This means smart money must engineer price movements towards areas packed with retail orders. They aren't reacting to the chart. They are navigating towards the available liquidity they need to survive. Retail traders are taught to place stop losses in highly predictable locations, usually just below the most recent low or just above the most recent high. This creates massive, invisible clusters of orders. This chart identifies sell-side liquidity, a dense pool of retail sell orders beneath a swing low. Institutions drive price down into this zone, triggering those orders and absorbing the supply to fill their massive positions. The same logic applies to buy-side liquidity above highs. These pools act as magnets. Institutional volume moves price from one liquidity concentration to the next, seeking the most efficient way to enter and exit. Support and resistance lines serve as a roadmap for these hunters, highlighting exactly where the largest volume of retail orders is waiting to be absorbed. Knowing these zones exist is one thing, but identifying the trap in real time requires looking for a specific signature as the price approaches a liquidity pool. A liquidity sweep starts with a sharp move through a support level, triggering stop losses and luring breakout traders. Unlike a true breakout, price retracts immediately, leaving a long wick piercing the zone. After this wick forms, the price typically reverses with high momentum in the opposite direction, leaving the retail traders trapped on the wrong side of the move. To avoid being caught in the initial spike, you must wait for a market structure shift. This is a break of the most recent short-term high or low that proves the institutional reversal is actually underway. Identifying this wick and reversal signature allows you to distinguish between a market losing its trend and a market being cleared of retail orders. To capitalize on this, you first identify a major liquidity zone and wait for the sweep to occur. Only after the market structure shift confirms the reversal do you prepare to enter. The ideal entry is not on the initial reversal, but the minor pullback that follows, allowing you to enter with institutional momentum behind you. Your profit target is the nearest opposing liquidity pool, resting above the next major high. This strategy provides a clear location for your stop loss, safely placed just beyond the extreme tip of the wick that performed the sweep. By following these structural markers, entries are determined by visible order flow. The outcome of the trade depends on institutional mechanics rather than intuition or guesswork. You can start identifying these institutional magnets on your own charts today. Use FXNX's advanced charting tools and high-speed execution to map these zones and trade in alignment with institutional volume.